Hey, what's good, guys? What's good? Super awesome to have you guys here. So, as you guys know, we did plan to go live and all of that nice good stuff. So this is us going live. Hopefully, you guys will have received the notification. So basically, just give me 1 second to make sure that everything is okay in terms of the sound and in terms of all of that stuff. Okay, cool. I see the sound is okay. Let me just make sure that everyone is notified of the session. Um, okay, cool. I think we should have everybody in the building with us. Cool, guys. So we should have everybody in the building with us. Super awesome to have you guys here. Let me just sort out a nice little light for us. Also, as well, slipped my mind. Sorry about that, guys. Let's do this. There we go. Cool. So we also have some light. Nice to have you guys in the building. So I will keep my eyes posted. I will keep my eyes here on my PC just to make sure that I am fully aware and up to date with all of the chats that come through. So I will also be reading your guys' chat so that we also discuss a few things wherever we need to. But nonetheless, let's see who's here. I see James Harrison saying I am the first. I see Paul saying that we're in the building. Nice to have you guys here. Let me just get my notes as well. So I do have some notes just to make sure that I do stick to what is relevant and we kind of try and refrain from digressing too much. So nonetheless, guys, you guys know that we are talking today about basically building a system. So I've titled this building a system because yes, obviously we're trading Forex. People call this thing a Forex strategy or whatever the case is. But nonetheless, doesn't really matter what you want to call it. Point being is that it is a system and it does consist of a whole couple of different elements. So within this overall system, there are a couple of different elements. So what I would like us to do, guys, is I want to teach you guys more than anything. I'm going to be referencing obviously my own trading process. So you guys will get to obviously see what my trading process looks like. But at the same time, that's not the point of this video. The point of this video, guys, is to teach you guys how to build a system on your own. How to think about the different elements that are involved in your system, how to know what to think about in the first place. So just let's start off by checking, okay, cool, we have something in the chat, in the building, let's go, aware, okay, cool. So we're good to go. So what I want us to do, guys, to start off is I want us to think about our trading process. What do we do when we're actually trading, right? So to get started, guys, we'll think about when we approach the markets on a normal day. Or let's just say, let's think about everything that we do from the time before we start trading till after we're trading, we're done. We want to think about that whole process and let's think about what is involved in that process. So first of all, obviously, we start off by analyzing the market. That's the first thing that we do, right? We analyze the market. So we're doing some analysis, right? So this is obviously the first part of our process that we need to start to define. Is before we do anything, before buy and sell, before the money, before the profits, before all of that, we need to first analyze the market. And so we need to, within our processes, have a process of analysis because this is one of the things that we need to do. So we're defining what we're doing in our process of analysis. Now I'm going to break it down to you guys in the form like I told you in the way that I do it, but I want you guys to think about this and really honestly look at this in a very subjective manner as to don't look at this as an objective rule and say this guy is saying I must have analysis and this guy is saying I must do this and this guy is saying I must do this, but look at it like this. Look at it like this guy is observing his process and he's seeing what he needs to do. He needs to do analysis. And now this guy is breaking down this process that he knows he needs to do and he's creating objective rules as to how is he going to do this task. That's how I want you guys to watch and absorb the information in this video. Not to say that these are objective rules. Now, in our process of analysis, we know that before we trade, so on a Sunday, on a Saturday or on a Sunday, whatever the case is, we want to be preparing ourselves for the next trading week. So we want to do what we would call in this case long-term analysis. So we want to have some long-term analysis. And on your guys' side, I would hope that you guys are actually writing down and whatever the case is, because I am going to erase, because I'm going to run out of space. So I am going to erase what's on the whiteboard. So nonetheless, hopefully you guys can see the writing here. But anyway, we want to have a long-term outlook on the market. So what our long-term outlook is before we start trading, what are the pairs that we are looking at first of all for next week? So we are basically preparing for the whole week. So what we want to do, we know that what's involved in our long-term outlook is obviously just our process of analysis. How we're going to select pairs and all of that stuff will boil down to our analysis process. So let's start off with defining what we're going to be doing in our long-term outlook. In our long-term outlook, what we need to have is we always want to be trading our higher time frames, right? And so we need to have a higher time frame directional bias and higher time frame point of interest as to where are we going to trade. So what we're going to do for our long-term outlook is we need to have basically a directional bias. I'm just going to put directional B. So we need to have a directional bias, right? Now to derive this directional bias, we need to determine a few things. Where are we going to find this directional bias, as in what time frame are we going to look for this directional bias on? And then as well as what are we going to use to determine our directional bias in the first place? So let's talk about time frames now. We want to have a higher time frame where we identify directional bias, and then we want to have a middle time frame. So automatically we've told ourselves that directional bias will come from our higher time frame. So our directional bias is being derived from our higher time frame. So now we are saying for our long-term perspective on the market, we are using a higher time frame to determine a directional bias. Now for this directional bias, what concept will we use to say that I'm deciding to buy or I'm deciding to sell? So let's create a small hypothetical example. Let me make sure that there's nothing in the chats before we move on too far. Cool. So we're going to draw a hypothetical example, right? We'll just draw some, I'm going to draw what my mind automatically sees. So my mind automatically loves to trade these ascending structures and all of that nice good stuff. So we're going to draw some example of an ascending structure. Cool. So we have this ascending structure, right? Now this ascending structure is in a bullish trend. So what I'm saying here, or rather what I want us to do is I want us to just conclude and define and say that for our directional bias, what we will use is structure. So we've said that we've defined long-term outlook, we're going to use our higher time frame, we're going to find a directional bias on this higher time frame, and we're going to use market structure to determine that directional bias. Cool. So we're using structure. Now we're defining what kind of structure are we using. So I'm going to just be broad about this, and I'm not going to go too in depth because that's not the purpose of this video. The purpose is to build a system. So cool. We're going to say that we're going to use our structure, which means both our horizontal support and resistance, as well as our ascending and our support and our resistance trend lines and all of those things, because it's so possible, guys, that yes, we're in an uptrend, but we can have a bearish bias. And as long as we can use structure to explain that directional bias, then cool, we've already defined a concept. Point being, we've defined a concept that helps us determine our directional bias. That's what we're doing. We're trying to remove as much discretion out of our process and include as much objective decision making as possible. Cool. So cool. So we've decided that, okay, cool, this is our higher time frame analysis. We determined that, okay, for this example, maybe we'll decide to be bearish bias. And the reason why we're determining this direction, remember, bearishness is a direction. The reason why we're determining that we want to trade in this direction is because we're at a nice third touch region, and maybe there's also some resistance at the top there. So as much as yes, this market is in a bullish trend, we're deriving a directional bias according to structure. So cool, we're bearish bias on this trade. Now what we need for our long-term outlook is we need to determine, obviously, a point of interest. Where do we want to trade this higher time frame directional bias? Now what we're going to do, guys, is we're going to say that for our point of interest, because we're looking for a point of interest. For our point of interest, we're going to use a middle time frame. We're going to use a middle time frame to determine our point of interest, right? Now, on our point of interest, what are we highlighting? We are highlighting our key areas. Key areas on that middle time frame. Now, whether our key area is, let's just say, this key area over here for a bearish bias, because we've determined that we want to sell. So we're looking for key resistance areas on our middle time frame. We're also, in other words, defining a concept. How will we find those key areas? We are defining this concept and saying we're going to be using structure to find these key areas. Now we're determining, because we have a bearish bias, where can we trade this bearish bias? We can trade this bearish bias at this key area. We can trade this bias after prices maybe violate this and turn this into resistance. These are the key areas that we can use to trade this bearish bias. Maybe we look for trades off here, but nonetheless, we are just identifying key important areas where we can trade this bearish bias that we've established from a higher time frame. Now what I want us to do now is just go a little bit further and now define what are these time frames. Now I'm going to reference, like I said, my own trading process. Now I'm going to define and say that my higher time frame will now be my daily chart. Why? Because I'm a swing trader, and this is the time frame that I'll be comfortable in, obviously observing that long-term perspective on where I expect to trade over the course of next week, because I'm a swing trader. So what I'm doing is I'm defining my rules, my concepts, how I'm going to do my analysis, and what I'm saying is now I'm taking this process and I'm making this process personal to me. What kind of a trader am I? And I'm making this process my own process that accommodates me as an individual trader. So anyway, nonetheless, I'm saying that now I'm going to be using my daily time frame to determine my daily time frame as my higher time frame. What am I looking for on this daily time frame? I'm looking for a directional bias. How will I find this directional bias on a daily time frame? I will use my structure to find this directional bias. I'm also saying that now I need a middle time frame, which is obviously a time frame lower than the higher time frame. Now I'm going to determine and define for myself that I'm going to use the H4 as my middle time frame. What will I be looking for on the H4 chart? I will be looking to find a point of interest where I can trade my higher time frame directional bias. How will I find my point of interest? I will be looking and highlighting key structural areas where I can trade this directional bias from higher time frames. Now that we have done and we've said that on a Saturday or on a Sunday, we are going to use this structure to determine our long-term perspective over the markets. Now we need a short-term outlook. So what I mean by short-term outlook, I'm saying Monday, Tuesday, Wednesday, Thursday, and Friday. What is our process for being able to trade what we want to trade from a higher time frame perspective? How will we be able to trade, do analysis, find the directional bias, find the point of interest, find our entry criteria on that or during the week when we want to trade? Now we're going to be defining that. Let me just find this eraser. Okay, cool, the eraser is here. Let me also check what's in the chats, guys. Let me check what's in the chats. I see super nice and simple. Asanda saying Forex chasers be doing the most. Forex chasers be doing the most. Most def. Cool. So let me just erase all of this. Just give me 1 second, guys. Cool. Awesome. So we've said that, just to summarize, we've said that we need a long-term outlook. Our long-term outlook needs to have a higher time frame and a middle time frame. On our highest time frame, we determine our directional bias. On our middle time frame, we look for points of interest. How do we find these things? We are using levels of structure, or whatever concept you use to determine structure, that is what we are using to determine a directional bias on our higher time frame and a point of interest on our middle time frame. Cool. That is our long-term perspective, how we are finding that long-term outlook. Now we are going to do, or we are going to be looking for a short-term outlook. So how are we doing and executing our analysis process short-term? So we want to have a similar structure. We want to have our higher time frame, our middle time frame, and our lowest time frame. Why are we including this lowest time frame? Because now we are actually looking for entries in the market. Cool. That being said, now we're going to do the same thing. We're going to say on our highest time frame for during the week, what we want to look for is we want to determine a directional bias. On our middle time frame, what we want to look for is our points of interest. On our lowest time frame, what we want to look for is for our entry criteria. Our entry criteria on our lowest time frame. Why do we have a lowest time frame? Because now we are actually entering the markets. Cool. So let's get into our process now. So for our directional bias, what are we using? We are going to be using structure to determine a directional bias. By structure, I mean everything, whatever concepts you use to determine structure. Someone else could use, just making a nice example, someone else could find a directional bias using something like moving averages. Even that is being defined. You are saying, I want to find a directional bias on my highest time frame using what? Using your moving averages. If your moving averages are down, then you're looking for a sell bias setup, or whatever the case is. Point being is that you have defined how you are going to, what are you looking for on that time frame, and how are you going to find it. Cool. Awesome, guys. We're moving, guys. We're moving. I like the progress that we're making. Cool. So on our middle time frame, we determined that we're going to be looking for points of interest. What are we going to use to determine our point of interest? Same way, we're going to be using structure. What the structure is telling us or showing us, or resistance or support or trend lines or head and shoulders, we are looking for structure to find points of interest. Because I can tell you guys that maybe, anyway, no matter what structure we use, whether we use a head and shoulders example, even if you're looking to trade a head and shoulders and you're looking at this area, it's still structure at the end of the day. Resistance that was broken above, broken back below, that market is coming back to retest. So nonetheless, we won't run away from structure. You obviously need to take it one step further and say, what structure are you using? Are you using the concept of support and resistance, trend lines, chart patterns? Are those the only concepts that you are using? If you are trading chart patterns, what chart patterns are you trading? Are you trading ascending structures, descending structures, reversal structures, continuation structures? You define every element of your process. Nonetheless, I'm giving you guys a structure. You're not here to go into detail. Structure, guys, structure. Nonetheless, cool. We're looking at our lowest time frame now. Lowest time frame, we're looking for our entry criteria. How are we going to find our entry criteria? We are going to look for chart patterns and candlestick confirmation. So candlestick confirmation. Those are the two things that we are saying that on our lowest time frame, for our entry criteria, we are going to look for what is the concept that we are going to use to enter. We're defining every single part of this process. We are going to use chart patterns and look for candlestick confirmation to be able to find, or these two things make up our entry criteria on our lowest time frame. Now we are going to define what are these time frames for the purposes of the type of trader that you are. If you are swinging, if you are scalping, if you are doing whatever, you still want to have the same process of having a higher time frame to determine directional bias, middle time frame, point of interest, low time frame, entry criteria. So now I'm going to give you guys reference to my own process and tell you guys that, okay, cool. For my highest time frame, I use my 4 hour. So my H4 will be for my highest time frame. The reason why I'm using the H4 as my highest time frame is because there is some commonality going on here. I can use the H4 and be common because remember, when I'm doing my long-term outlook, am I looking at any other time frame besides my highest time frame and my middle time frame? No, I'm not. So when I'm trading during the week, don't I still want to have some reference as to what that higher time frame structure that I was looking at on my long-term perspective, how is that higher time frame structure developing? Yes, I do still want to have that reference. So what I'm going to do in my process is for my short-term outlook during the week, I'm not looking at the daily anymore during the week. Now as my highest time frame where I'm looking for my directional bias using structure, that time frame will be the 4 hour. So now I've defined the time frame that I'm using as my highest time frame. What time frame am I using for my middle time frame? Obviously we'll go one time frame lower. So I'll use the H1 as my middle time frame. What am I doing on the H1 chart? Whenever I'm on the 1 hour chart, what am I doing? I'm looking for points of interest, for areas where I can be able to find those trading opportunities using what? Using structure. And I've also defined what is structure to me. To me, structure is my support and resistance, structure is my trend lines, structure is my chart patterns and structures that develop within the market. Every part of the process is defined. Now we're going to say, what is my lowest time frame? Maybe my lowest time frame can be the 15-minute. So now I know that whenever I'm on the 15-minute, on the 15-minute is my entry criteria. That's where I'm looking for my chart patterns. So which means that in our previous example of that structure that we drew, that ascending structure, cool. We have our point of interest. What are we looking for on our smallest time frame in this area? That's our point of interest. We are looking for a chart pattern in this area. Once we find a chart pattern in this area, we are looking for some candlestick confirmation in this area. Once we have our chart pattern and our candlestick confirmation, then we are taking this trade. Once we have our chart pattern and entry criteria, then we are taking this trade. Doesn't matter what the setup is. We have a point of interest where we are looking for the setup. We know that on our lowest time frame, once price is in our point of interest, we should be looking for chart patterns and our candlestick confirmation. Chart patterns and our candlestick confirmation. Let's not digress way too far. So guys, we've literally just defined our whole process of analysis. If you guys have been following, we literally just defined our whole process of analysis. So now we know. What are we doing before? We're doing some analysis. What do we have in our analysis? We have long-term and we have a short-term view. Long-term, we have a higher time frame and a middle time frame. Short-term, we have a higher time frame, a middle time frame, and a lower time frame. Have we defined every part of this system for our process of analysis? Absolutely. Which part of analysis have we left out? There is no part. Everything is defined to the T. Now, what are we doing after our process of analysis, guys? So cool. In our trading process, after we analyze the market, what are we then looking to do? We are then looking to enter the market. Cool. So I did skip one thing. Let's actually take a step back. I did skip one thing. Let's take a step back. After our analysis, after we analyze the market, what do we then do? We forecast and we say, if the market does this, then we do that. And so after our process of analysis is complete, we need to have a process of forecasting. Okay. We need to have a process now of forecasting. What do we need to forecast the market? Only two things, guys. Only two things. We need a directional bias. Which direction do we want to trade? And we need a point of interest. That's all we need for our forecasting. If we have a structure, let's just say market is doing something like this. And this is where price is right now. When we forecast, what do we do? When we forecast, we say, I want to trade in this direction, which is our directional bias. And what else do we say? I want to take the trade in this direction at this area here. That's literally all we need for our forecast. Just a directional bias. And where do we want to trade this structure? How do we find these two things? How do we find the directional bias, guys? We have our directional bias and obviously our long-term and our short-term analysis point of view. We have literally everything. How do we forecast? We need these two things. How do we find these two things? Our process of analysis will give us these areas and that directional bias for our forecast. Our forecast doesn't need to go into detail as to say that in this area I'm looking for a descending wedge and then followed by a reversal structure, break of structure, continuation to the upside, and then one. Guys, come on now. Let's be realistic. We know that as much as we can forecast like this, market won't do this. Market won't do this. You'll find out that where you're looking for that whole big complicated thing, market just does this. Done. Done with all that big forecast that you are doing. So all you just need is you want an area where you want to trade. When price gets to this area, what are you looking for on your small time frame? Your entry criteria. Have you defined that? Yes, you've defined that. So there's no point in drawing whole 5,000 mock-ups on your charts and all of those things. Maybe yeah, if you still want to nurture your process. But there's no point because you've already defined that. You've defined your entry criteria in your head. You know what structures you're looking for here. You're looking for structures that confirm your directional bias. That's simple. So cool. We've defined now our process of forecasting. Now, after we've forecasted, what are we looking for after we forecasted? After we forecast, now we're looking to actually enter the market, guys. After we forecasted, now we are looking for our entries. Hey. Things are getting hot, things are getting hot, things are getting hot. Cool. So for our entries, let me show you guys this hack. I'll show you guys a nice hack, the hack of a lifetime. Let me check what's happening in the chats, guys. Let me check what's happening in the chats. I see in the building, please save this video. US 30 is breaking boundaries. The quality is very bad, but the training is good. Video quality, bro recording or on a Nokia. I'm sure it's just the network, guys. I'm 100% sure it's just the network because I trust my phone. But anyway, let's double check that we're all still good here, even on the phone as well. So cool. Now anyway, let me give you guys this life hack. This is the life hack of the century. Now we're defining our entry process, right? We're defining our entry process. Now let's think about this. Let's think about it for a second. Did we not talk about our entry process when we were defining analysis and said that lower time frame, we're looking for chart patterns and we're looking for candlestick confirmation? Man, this is so beautiful. Do you see how like one simple process, like taking all of your time to just focusing on just sorting out like one part of your process indirectly makes you think about so many different elements of your process. This is the reason, guys, why I've said it before and I will always keep saying it, that if you have never written down your process, you don't have it all together because you've never really given yourself the time and the opportunity to think your process through. Think it through, not in the process of doing it, but think it through from the outside. because it's so difficult, guys. I know a lot of traders haven't reached the point where they can be in the heat of the moment. I'm trading, I'm in it right now, I'm in it. But still be able to step out of that moment and look and observe and make decisions from the outside. It's difficult sometimes. So now, by you taking that 5 minutes a day to just think about your process, just think about creating a process. Imagine you are taking that time out away from the markets, away from being in the motions, and you're using that opportunity to the fullest of its potential, because now you can look at your systems, you can think about your processes from outside, not from the process of doing it anymore. So anyway, let's get into our entry process. We've defined our process of how are we going to enter the market from our lower time frame structures. If you guys are going to tell me about something like no trimming, we didn't define what kind of an entry that we are going to take. We're talking about entries. Man, if you have defined your lower time frame enough, if you have defined, remember I'm telling you guys that I'm not giving you guys specifics. I'm teaching you guys how to build your own system. That's the gift. I want to give you guys the gift of building your own system. Be your own engineer. I don't want to spoon feed, but I'm saying that if you have defined your lower time frame entries, when you are thinking about what chart patterns you are trading, if you tell yourself that I'm going to trade a descending structure, have you not already concluded that the two types of entries on your descending structure is either this risk entry at the third touch or the reduced risk entry after either prices break structure or break this high and give you continuation? Have you not already defined all of that? Guys, the power of thinking about your systems. If any of you guys are in this video today, and after today, you don't mandate yourself to go and think about building your own system, I can promise you guys that your journey is going to be very much difficult. Not impossible, but it's going to be very much difficult, because you won't know when to and when not to. You won't know how to and how not to. You might think you know, but you won't know in the most detailed and most efficient way possible. You're just going to be analyzing and looking at higher time frame, top down, daily, 4 hour, 1 hour, because someone told you to. Not because you understand why you should be doing those things. But anyway, let's get back to what we're talking about. We're talking about, so after we analyze the market, we then forecast. After we forecast, we then enter the market. What happens after we've entered the market? Now we are starting to manage this trade. Cool. Now we know that we need to define a process of trade management. Let's just stand here. Okay, cool. Trade management. Now we need to define a nice process on how are we going to manage our trades. After we've entered, we're in the market, we're here, it's hot, it's nice, it's blue, it's red. How are we going to manage this trade? Now we need to define how we manage. There's only two ways that we're going to manage trades, right? We are either going to be cool. We're either going to be reducing risk, or we're going to be one of two things. We're either going to be reducing risk when we are managing our trade, or we are going to be partially out. Now, how do we manage, how do we reduce our risk? Only one way, guys. How do you trail your stops? How do you trail your stops? Now you know that managing trade only involves two things: reducing risk and partially out. It does not involve closing your trade on your own. Unless you've defined those rules. Let me just add there, unless you've defined those rules, then you can go ahead and do that. Because even myself, I have processes of managing where if I'm in a buy and price impulses back to my area of resistance, I can close my trade out if I want to. So if you've defined those rules, point being, just define the rules. Leave no room for discretion in your trading. Leave no room. Everything should be as rule-based and as defined as possible. But anyway, we know that the only way to reduce risk here is by trading our stops. So now you define for yourself, how are you going to trade your stops? The most common way of trading stops obviously is when people say, maybe if I'm selling and I'm in a downtrend, I'm going to trade stops below, above swing highs. So obviously this is not enough. This is not definition enough that I'm going to trail my stops above swing highs. I need to define what the hell is a swing high in the first place. How do I say that this is a swing high? Now you define your process even more. You say that I said that I'm going to trail my stops according to swing highs. Now I need to tell myself what is a swing high to know exactly when to move that stop loss. Now I'm going to say a swing high is after the market creates a lower structure, I need to see the market create a high. After the market creates that high, if prices break and close below the low of this first support, then my swing high is confirmed, and at the close of this candlestick, I will trail my stop losses above this high. Same thing going. Once prices establish a low, establish a high, and break and close below this high, once the market closes below this high, that is a swing high, and that's when you should move stops. Now you also define further. How are you going to trail your stops? You can define further and say that I will trail my stops on my entry time frame structure. Whatever your entry time frame is, if your entry time frame was the 15-minute, then you are even defining that further and saying that I'm going to manage my positions on my entry time frame, or I'm going to manage my positions on my middle time frame. Have you already defined what those time frames are and what you should be looking at on those time frames and all of that nice good stuff? You guys are smart. You've already defined all of that. So you're defining how are you going to be reducing your risk. Now you can define further. How are you going to partial out? You could obviously either partial out in two ways. You either partial out according to your percentages, or you partial out according to your targets that you've set for this trade. Targets, how are you going to structure your percentages? Your percentages is a very automatic thing. When prices get to 1:1, you partial out. When prices get to 1:2, you partial out. When prices get to 1:3, you partial out. Nonetheless, you are defining how are you going to execute the process of partialing out. You could also partial out according to setting different target areas. How are you going to set these target areas? You can define for yourself that you are going to use entry time frame, or maybe even you can use middle time frame structure, or whatever the case is, because remember, you're identifying points of interest on your middle time frame. You can then say that I'm going to set multiple take profit areas, or areas where I partial out of my trade. That's what you're doing when you're setting TP1, TP2, TP3. You're partially out of your trade before the final termination of that position itself. So you can say that I'm setting my targets according to middle time frame structure, or whatever the case is. Nonetheless, you are defining these two parts of your process. You're saying that part of my trade management involves reducing risk and partialing out. Part of my reducing risk is how am I going to reduce risk? I'm going to trail my stops. How am I going to trail my stops? I'm going to trade it according to the structure that I see developing. How do I determine and confirm that structure? I've defined that already. How am I going to partial out? I'm going to partial out using percentages. That's simple and straightforward. No gray area there. Black and white. Or I'm going to partial using setting multiple take profits. How are you going to set that? Using middle time frame structure. You've defined every element, every part of your trade management. After we've managed our trades, guys. After we've managed our trades, what's next for us? Now that we've managed, we are exiting the position. Cool. So now we know that we need to create a process for how we are going to be exiting our positions. Now we're going to say to ourselves, there's only two ways that we're going to exit this position. Or you can put a third one if you want to. But for me, there's only two ways you're going to exit a position. You're either going to exit your position by stop loss, or you're going to exit your position by TP. One of the two. You're defining now. You're saying that for my exits, this is how I'm going to exit my position. Now you need to determine and say, how am I going to set my stop loss? You can either say you're going to set your stop loss based off your entry time frame criteria, which is obviously your lower time frame, and we already defined that on the lowest time frame. We're looking for this structure. So obviously, if you find a double top structure on your lowest time frame, whatever the case is, and you get a whatever there, where's your stop loss supposed to be? Maybe above the overall structure itself. Cool, there. So you already defined for yourself that I'm going to exit using stops, and how are you going to place those stop losses? You are telling yourself that I'm going to use whatever structures I find on my entry time frame to place my stops. Now you know I'm going to exit. The other form or other way I'm going to exit this position is through take profit. How are you going to set your take profit areas? Very simple. You want to maximize your risk to reward ratio. So what I do is I manage my risk, which is obviously my stop loss, on my entry time frame, and I manage my reward, which is my take profit, on my middle time frame. So what am I doing? I'm saying that I'm going to set stop losses and I'm going to manage my trade based off the structures that I find on my entry time frame, and I'm going to maximize on my reward by setting take profits based off my points of interest, my important points of interest on higher time frame structure. Because what? It's going to be a lot further. If we go back to our same first example, like the first example that we ever had, what can I erase? Let's erase some of this. Cool. We'll just put this here. We'll say that we spoke about entries. Cool. Now I want to give you guys the same example that we spoke about the first time. That we have this higher time frame ascending structure, and we obviously concluded that maybe we want to be trading in this area over here, and we said that when price gets to this area, what are we looking for? We're looking for that further. So in this box, this small box here, I'm going to erase this, and we're obviously saying that within that small box, we are looking for another chart pattern to confirm this entry and tell us whether we should look for this risk entry or maybe we should look for this reduced risk entry. So obviously we know that that's our overall structure, that's our third touch, this is our second touch, and obviously this is our first touch. So we're just redrawing the same big overall structure. Now what are we doing? We're saying that our stop loss is going to be determined by this smaller time frame structure that we are finding here. So obviously stops well managed, entries being here, stops well managed above the high. Now where are we setting our take profits? We're setting our take profits at this important key area over here. Important key areas that we can observe on our middle time frame, on that time frame where we are identifying points of interest. Why? Because we want to maximize on risk to reward ratio. So we're making sure that we are setting our system up to automatically. We're also indirectly also defining risk to reward ratio and all those things which we'll go into later. But what we're doing is we're making our system automatically encompass these things that we want to have as a profitable trader. You want to have a system that obviously minimizes risk as much as possible. You want to have a system that maximizes reward as much as possible. What we're doing is we're putting that into our system so that whether or not you are taking that scalp and you're going against your rules and you find a 1:2 trade or 1:2 whatever trade or whatever the case is, if you are still following this rule of trading a smaller time frame structure here and obviously setting your targets based off higher time frame confluences, you'd still have a big risk to reward ratio automatically just by following this rule. You might even have more than your minimum risk to reward ratio, which is still a plus on your system. But anyway, nonetheless, we were just trying to go into this example here about our exits, how we're robbing the system and creating a nice process from our exits. So that's cool. So going back to our process, right? Going back to our trading process. So we've analyzed, we've forecasted, we've entered this market, we've managed our trades, and we've exited our trades. There's one thing that I guess encompasses and ties everything else up. Everything that we've spoken about, there's one, whatever you want to call it, I don't know what you want to call it, but there's one thing that obviously needs to be done to tie everything up and to ensure trading longevity. You want to be in the markets to trade another day. You don't want to risk so that tomorrow you're trading a demo game. Man, even if you have a $20 account, you don't want to risk that $20 account so that tomorrow you end up practicing on a demo game. You want to be able to trade the live market as long as possible, because that is what's going to teach you as much as possible. That live market time that you spend there is going to teach you a lot. So obviously you want to now. Okay, let's do it this way. Cool. I'm sure we all saw this one coming. I'm sure we all saw it coming. That the risk management. Now, obviously, we need to define a process for risk management, and we need to think about what's happening here in risk management. What are we taking into account? So for our risk management, we're obviously taking into account, number one, the most important thing that we're taking into account for risk management is our own Cool. We're taking into account, number one, our own risk tolerance. How much are we able to lose? Like, what is our risk tolerance? Yes, everyone has like general risks, risk 1%, risk whatever. But trading is very subjective. Trading is subjective. 1% might even be too much. Like, I know for me, 1% sometimes is too much. Like, I'm comfortable even risking 0.5% of my account. Even lower. Like, sometimes I'll take a risk. Funny, like, you'll come and tease me. He'll say, man, how can you trade a $10,000 account with 0.01? And it's funny. It's definitely funny. But at the same time, that's your risk tolerance. That's how subjective things are. Do you want to even take a 1% risk? And I know some other people take more than 1%. Some people take less than 1%. But that's you determining your own risk tolerance. First of all, your risk tolerance involves how much of your total account size do you want to lose before you say, let me stop and let me go and review my processes, or let me take a step back and review myself, or let me do this, or let me do that, or manage yourself as the trader. What is your maximum risk tolerance for your account? If I'm trading a $100 account, how much of that $100 do I need to lose before I say stop, whoa, Tremaine, chill, go and do something else, and then come back to the market when you are 100% confident and sure and here with your processes that you will do a lot better than you've done during this period, or whatever the case is. Your total risk tolerance. You also want to determine a risk tolerance per trade. Are you that person that wants to take 1% per trade? Are you then one person that wants to manage risk according to correlated pairs? Maybe you have like a total combined risk of 5%. Maybe you only want to open a maximum of 4 trades, combined risk of, I don't know, 10%. Oh, geez, guys, I just see that my network was gone there for a second, guys. I do apologize for that. I think my battery was a bit low, but I'll just check what's happening in the chats. Oh, I see you guys saying frozen. Okay, cool. Frozen. I'm so sorry about that, guys. I do apologize. Hopefully we're all back. That was on my end. Sorry about that. Cool. So we're defining our risk management, and we're saying that we need to obviously see what is our total risk tolerance. Now, also at the same time, part of us knowing what we want to risk, we also should know what are we expecting to gain from this whole process, like from us managing risk. What do we want to see? What kind of rewards are we looking for? And then obviously that brings in looking at things like our risk to reward ratio. So you think like defining your risk to reward ratio and all those other things that fall under that you've had under risk management, that's all defining our process. And you guys will find that if you guys literally have thought about everything that we've discussed, our analysis, our forecasting, our entries, our trade management, our exits, and our risk management. If you guys have literally thought about each and every one of these processes, there is no part of your trading process that is subjective. Literally, you'll find that you'll be able to spot. There's going to be no part of when you take a position, when you buy and when you sell. you'll immediately know which part of your process did you mess up on. Did you mess up on your entry time frame? Did you mess up on your points of interest? Did you mess up on your risk management? Did you mess up on your what? On your trade management? You'll be able to identify any part of your process. You'll be able to see it as it is. You'll be able to know where to start, where's the problem, where should I begin to fix. You'll be able to know how to modify, because now you're thinking about the different ways. It's like if trade management was your issue, you would know that there's different methods of partialing out because you've thought about it. You know that if partialing out according to setting multiple take profits is not working for you, there's another way. Why? Because you've thought about that system, you've defined how you are going to manage this trade. If you've never defined that process, you're going to continue to just walk and be drunk, literally be drunk in the markets. And today you're going to partial out using like this, tomorrow you're going to do that, the next day you're going to do that. Where's the consistency in following through on that process? There is no consistency in following through on the process, so there can't be a consistent result, a consistent expected result. That's what literally just building our system entails. So point of the video, like I said, like maybe 5,000 times, guys, is the main point is not to tell you that this is the ultimate process that we should be doing. The point of this video is to make you think like an engineer. Think about what you want to do. Think about the steps that are involved in doing it. Think about how you want to create those steps. Like, what are the steps itself? You're creating the whole process for yourself. And once you've got the process, you can backtest the process. If you don't know how to analyze, how are you even going to say that I'm going to backtest? Because you don't know. You already don't know that to make my backtesting simpler, what I can do is I can just backtest my higher time frame structure. If I'm backtesting AUD USD, I can literally backtest higher time frame structure. I know I'm backtesting the daily. What am I looking for on the daily? What do I want to be comfortable? I want to be comfortable with observing structure, daily structure, and finding directional biases. I'm done my backtest for the month on AU. Not worrying about entries, I'm just getting comfortable with daily structure and finding directional bias. Next day, I'm gonna do my backtesting on AUD USD. What am I looking for now? Now I'm getting comfortable with finding points of interest. Backtesting points of interest, getting comfortable with the structures. How do these structures develop? When I find a point of interest on AU, does AU do this to this point of interest? How does AU treat from our directional biases to finding points of interest? How does AU follow through on that forecast, on that analysis, or on that whatever? Once I've done that, when I'm backtesting and I'm on the, let's just say on the 15 minute, because we determined that's our entry time frame for this example. When I'm on the 15 minute and I'm backtesting, do I need to start top down? And I'm in the process of backtesting. Do I need to start top down analysis and start daily 4 hour, 1 hour, 15 minute? Do I need to do all of that? No, I don't. What I can do is just be jumping in between maybe my entry time frame and my middle time frame, because I'll already be aware of what higher time frame is structured, what higher time frame structure is doing. I'll already be comfortable with what higher time frame structure is doing. Guys, just do me a favor, one favor, and I'm gonna say it again. If you're watching this video today, and after this you don't go and think about every one of your processes, your trading journey, and it's a promise, is going to be difficult. Because it's very difficult to move somewhere without a plan. There's no business that operates that has an objective goal, but that doesn't have a business plan on how to achieve that objective goal. You are building a system, a strategy, a whatever you want to call it, a process. Nonetheless, what you're doing is you are introducing habits into your process, into your living, into your life. You're introducing a habit. You're introducing routines, and what you're doing indirectly is shoving these things in your subconscious. The longer you do it, the more comfortable you're going to get doing these things, and obviously it allows you to focus on other things. Analysis is no longer your problem because you've done it so often, so much. You've repeated the process. You know exactly what you're looking for in every time frame, exactly how to find it. Analysis is no longer your problem. Maybe forecasting becomes your problem. Do forecasting enough, define that process enough, it's no longer your problem. Entries becomes your problem. Forecast your entries, define your entries enough, backtest your entries enough. Entries is not going to be your problem anymore. Your trade management might be a problem. Now you can focus on your trade management, define your trade management, do that routine so often enough that it's in your subconscious. Trade management is no longer your process. You're part of your mess up and your confusion. Now exits is. Once you've determined your exits, risk management is. Once you've determined your risk management, now the only battle is with this. Now you can leave all of the technical analysis. You're out of your process of learning. When it comes to perfecting a process, when it comes to doing this, now you can shift your focus, you shift your attention to managing this guy, to giving this guy, doing things like ASR, reviewing how this guy was feeling, how this guy was thinking, how is he executing based off this process, how is he functioning, how can the process best suit this guy, can I maybe change this process and maybe make my process a scalping process because I can see that this guy is not handling being a swing trader or something of that nature. Now your focus is shifting away from all of this crap that you've been learning, all your technical analysis crap, and now you can start to focus on the real journey, because the real journey ultimately is with the self. And how can you try and combat your psychological issues when you are still thinking about your technical processes and still being comfortable? It's too much to juggle. It's too much to juggle. Rather than to laser focus, get all of this out the way, all of these processes out the way. You replicate these processes and you learn the psychology. Remember that psychology is not even something that you can change in a day, in a month, whenever. There's no time limit to psychology. And so psychology should be that one thing that each and every one of these processes is working on. Process of analysis is getting you used to developing a system. Forecasting is getting you used to discipline and sticking to what you wanted. Entries is getting you used to following a specific process of not jumping in too early, too late, too wherever, defining your entries. Risk management is, guys, everything will just literally fall into place. It literally starts with just the preparation, guys. I think for me, I'm 100% through with the session. I think we've gotten through what we needed to get through, building a system, building a strategy. Maybe I'll take like a couple of seconds just to check what's happening in the chats, just to see if there's any questions or anything before we call it a session. When should you close your trade on indices after you have a sell or a buy? It's a very subjective question, guys. Very subjective question. This lecture is a killer. This is what I've needed. Informative, frozen. Cool. Now, many thanks for the clarification here and there. Keep it up. Very informative. I see some diamonds there. Otherwise, guys, to me, from the chats, it looks like everybody is cool. It looks like there aren't any questions there. So let me call it a session, guys. Call it a live session. Thanks so much for being part of the session, guys. Yeah. I'll see you guys. Yeah, cheers, guys. Let me end the session. Cheers. Thanks, guys.